Friends, in this video for I Thought Wealth, I'm going to talk to you on the topic, the dividend option in mutual funds. I know a number of investors who are very particular about getting dividend from mutual funds. The profile of these investors is very widely varying. A very young person who is saving for his retirement also picks the dividend option. And a person who is actually retired and needs some income to hit his bank account with periodicity also picks dividend option. Their reasons to pick the dividend option must be justified, right? If it's a retired person, then he is looking at those returns to run his life. If he doesn't need those returns to run his life, why would he need to take a dividend from a mutual fund, add it to his taxable income and pay taxes on that? If he left it just like that, it would continue to compound and he wouldn't have to pay a tax. Let's come to the young person who has habitually chosen the dividend option. What is he doing? He is taking capital out of his investment every year. If he didn't do this, that capital would be available for further compounding. Remember, he doesn't need the money. He is actually investing regularly towards retirement. If he chose the dividend option instead of the growth option, what he does every year is periodically removes money out of his capital, which then may actually get spent or allocated somewhere else and is not available for compounding in his investment. This effectively reduces the outcome of his compounding. It plays a negative role in creating the desired returns for him, because whether the market is on top or at the bottom, the dividend will come. Assume the dividend is taken when the markets are running low, then he is cashing out at the wrong time. Assuming the dividends are taken when the market is higher, then he is probably doing the right thing of taking the money out. But how many people look at this? Because once you choose the dividend option, you don't have a choice of deciding whether to take the money or not take the money. You have left it to the mutual fund to give you the money at a time they decide. Effectively, your capital allocation is now passed on to the fund manager and he returns capital to you irrespective of whether it's a good time to return capital, because that's how they work. On the other hand, there is another way of looking at this whole thing. Assume you don't need money from your investment, whether you're young or old and retired. When you don't need the money, you just allow the money to compound. When you feel that investments have run up too fast or the valuations are too high, you take out money to the extent of dividend and keep it in a safe place. Later, when you find new opportunities, you invest that money back into those opportunities. The money you took out of the investment is a capital gain and you pay capital gains tax according to whether it is long term or short term. Inevitably, it will be long term, so it is 10% plus whatever is the applicable surcharge. So, your tax rate is actually probably going to be lower than whatever you would pay on the same sum that you withdraw if you treated that money as dividend income. So, from a tax point of view, it doesn't make sense to take dividends out under the present regime. And from an investment point of view, you are always exposed to the risk of taking out money at the wrong time. I have never been a proponent of choosing the dividend option. I feel that if you want to take out money, you take it out when it is opportune to remove money and run your investments on the growth option at the other times. Effectively, I would let compounding to run as long as it's worth running that investment, and only when it becomes too good to be true, then you think of withdrawing money from that investment, keeping it in a safe place, paying only long-term capital gains and keeping your taxes low and always having some money, your powder ready, so that you can make it work for you whenever the markets come down. Dividend option is only for those who need regular income for running their life, who need that money to do something. Otherwise, I would think that you should stick to the growth option. I would go one step further and say that if you are the kind who can manage your investments in a dynamic way, then you can still choose the growth option and take out money for running your life whenever you need it or you feel it's the right time to take out money. Taxation in the growth option is any day better than taxation in the dividend option, and that is why I feel that the old habit of compulsively choosing the dividend option should be thought over, and you need to rethink what you do on that. Thank you for watching this video.